Hello, everyone. Thank you for joining us for the New Capital webinar, Special Markets Update 2020, number 5. This is Catherine Barr, the Director of Communications at New Capital. As usual, Leonard will be answering the questions at the end of the presentation. Please feel free to submit any questions you have during the presentation in the Q&A tool. It should be in the webinar menu at the bottom of your screen. And before we get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or any services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you, and I will turn it over to Leonard.
Catherine. Good evening, everybody, and hope you are doing well. Happy Friday, and I guess I'd like to start by first asking, is anybody on the call, there's a hand raise, or anyone in your immediate family or how do I want to say, or a good friend or a close family member have the virus? Just maybe just give a hand raise. I'm trying to think. There's a way to.
Yeah, Leonard, I can see that on your screen. You should be able to see the participants, but we've got 3.
Okay, yeah, I see. So 3
hand raises.
About 30%. 3 out of 10 people either have the virus or knows close friend, family. You get the idea. Somebody who's in your orbit. And I guess as these webinars go on, and we intend to keep doing them during this crisis, that we'll keep track of that just to see. And I want to say it's such a strange time. I flew back from Colorado last night, where I'd been for the last couple of weeks, and I got home, and I've only been gone for 2 weeks, and it seemed like it was 2 years. It's just, and I think a lot of people are commenting on how time just seems to have slowed. Yes, the pace of daily life is slowed too, as everybody is either quarantined or kind of quarantined. But it's interesting how our entire perception of time seems to have changed in this, and so. And then I also want to say it's very difficult to see reports out of New York and Italy and all parts of the world of people losing their lives to this virus, and we just hope we'll get through it as soon as possible. And I know all of our hearts go out to families who are affected, and hope everybody will stay safe. So anyway, I want to start with that. Some random thoughts here. I think it's now clear that the country was unprepared. I think that's a statement that we can make if we're looking at reality and really trying to. In fact, country appears to have been quite unprepared for this. The CDC, with its failure to have tests in place, essentially that has resulted in everybody having to hunker down because we don't really know where the virus is until it starts to materialize. And so cat was out of the bag very, very early on. And of course, we're seeing that the country has been unprepared with its supplies of PPE and ventilators, And we'll have to do some deep thinking about why that is. It's not the first time the country has been unprepared or caught by surprise. And I know many people argue that this wasn't a surprise. That the indications were coming out. I'm not able to assess that, but it does appear that the country was unprepared. We were caught by surprise in Pearl Harbor. We were caught by surprise in 9/11, and it looks like we've been caught by surprise or unprepared. The U.S. worst case is one of the worst. If the worst case materializes, and we don't know, it's not looking great right now, given the curves will be conceivably the worst case, at least in the industrialized world, the developed world. And my understanding of the charts is that we're on pace for that. That in some ways our curves look like Italy's. Italy's have begun to turn down, but my understanding is that Italy took earlier action and has taken more draconian action among its population than the United States has. So we could be looking at that. I don't know about India. I don't know about Brazil. I would expect that those countries may have an even more difficult time. But we're at the beginning of this right now, and I think that the news and the reports as the days go on are going to be very, very difficult to get our minds around, and our hearts as well. European jobs model. I've been very disappointed that the United States and the government did not elect to go the European route. Not all European countries are going this route, but many are, where they're providing direct payroll subsidies to the companies, which allows people to keep their jobs. And I'm sure the devil's in the government pay the differential between current business and where business was or should have been. But the fact that we're getting this week 7 million layoffs in addition to the 3 point something from last week, 10 million jobless, I think just says that the other way to go is the better way. People get to keep their jobs. It's less stress. You don't get these sort of severe dislocations. So this is a concern. We'll see where it goes. But I think that when this is over, there is going to be enormous amount of discussion and debate, and probably legislation as well, to make sure that in these sorts of cases, people can keep their jobs. Municipal bonds. I spent some time on a call this week with Vanguard. Your municipal bonds. The municipal bond market has had some dislocations. You may have seen that in your portfolios. That some of the municipal bond funds maybe are now showing losses of 3%, 4%, 5%. And I was pretty assured on the call with Vanguard that the market is stabilizing, and that the reason that we were getting such dislocations is that people were simply grasping for cash a couple of weeks ago and selling bonds. And the municipal bond market is a very different market than the Treasury market. The Treasury market's huge. Everybody all over the world buys treasuries. Municipal bonds tend to be owned by retail investors such as us. Institutions don't tend to buy it because institutions are tax-free. Generally, pension funds are not taxed. Foundations are not taxed. They don't tend to buy these bonds unless the yields are much higher, which is what happened in the sell-off. And so as everyone looks at their portfolios and says, what's going on with muni bonds, I feel pretty assured that the market is stabilizing and is normalizing. And actually, as prices got low and yields got higher, we saw a number of institutions step in and start to buy these bonds. But I'm still confident in the strength of municipal bonds. There are some concerns about municipal pensions now having difficulty, and of course, the cost of hospital districts and so on. But the funds that I buy for you are very broadly diversified. But I will keep watching this and attending all the calls in the case of municipal bonds. we're all adjusting right now. And it's remarkable, I think, how quickly people are adjusting to this new life and this new world of distancing from others and engaging in Zoom teleconferencing. And so I think that's good news that one of is a great ability to adjust. I continue to be concerned about lower income segments of our population. And I think the government's going to have to make sure that those segments get what they need to get through this. And I am not convinced that we are there. That is my biggest concern right now. We will get back to business. We will find a vaccine, but we need to make sure that rank and file people, lower income people in our country, are taken care of through this. What's happening to them is not their fault. I continue to look and try to think about inflation and how would, if we were going to see inflation, how would that transmit into the economy? It's not clear that we're going to get inflation. We could get deflation, but I think it's going to be inflation. One of the things I've been thinking about over the last couple of days is what happens when the coast is clear, whenever that is, whatever that looks like, and people want to go back to their hairdresser and their nail salon and their restaurant and all the other service providers who right now are shut down. And it's conceivable that those who never wanted to be in that business or weren't very good in being that business are now out of the business. So we have fewer providers and we have a big rush. And my guess is that those service providers are going to raise their prices. They're going to say, I had to go without income for all these months. I'm going to double my price in order to make it up. And I'm just trying to think through what do we see in the way of inflation? And I've talked about inflation on the other calls. I continue to think about that and sort of how much inflation fighting bonds am I going to put into portfolios? Haven't decided yet, but I'm pretty close on making some decisions there. I want to encourage everybody, if your estate plan is not up to date, if the virus comes for us, apparently it comes pretty quick. And I just want to make sure that if you do not feel confident in your estate plan, if you have not reviewed it, if you do not have a will, if they are out of date, please take the time to update them. Don't delay on that. Don't just assume that it's what it needs to be. If you need help with that, we've got a lot of estate attorneys in our database. Look at using somebody else. We've even got a number of attorneys who are doing updates through Zoom and through remote means. But I encourage everybody to please, if you need to, take a look at your estate plans. I wouldn't want a situation where you get sick and even fatally sick, and your family has to figure out a mess or just something that's not as clear as it should be. This payroll protection plan, we have gone our clients who are in small business, and we're addressing each separately. But if we haven't gotten to you or you know somebody, this payroll protection plan, which is the small business directed part of the federal assistance, it's kind of chaotic. They basically have sent a big rush to the banks who are going to be lending. It's not the government lending directly. It is the banks which are being backed up by the federal government. And as far as we can tell, and JC and I have been doing some work on this, JC especially, it's kind of a mess as everyone rushes to get their applications in. And so if you know somebody, feel free to get a hold of us, because we're not experts in it. The CPAs are kind of farther ahead in this because there are large tax implications and it works with company payroll, but we are involved in it. So let us know if you're having trouble or if we can provide assistance. There's talk now in the government about some infrastructure rollouts. We've heard about that for decades. It looks like this is finally going to be, it took a virus. It took not just a virus, it took a global pandemic for the United States to make an infrastructure plan. I mean, that's kind of sad. It took a pandemic for us to decide to fix our infrastructure, but it does look like that's going to happen. I think we should all be supportive of that. Hopefully it's going to be something that is done well. and addresses needs. Finally, as regards my response time by email, I'm doing the best I can. And so if you send me something, I will get back to you. If I don't get back immediately, it's just because I'm having to triage my email. And so some of the email is kind of urgent, or somebody needs a transaction or something done. And other emails are, what do I think? Or what do I think? It's all important, but just bear with me. I was on I'm in Austin 3 or 4 times a year, and we had a virtual meeting yesterday, and another, 15 other advisors from around the state are in the group, and we're on the call. It was very about what's working, what's not, how can we help each other. Everybody's working very hard in this business right now, and so it's just the nature of it. We are still in triage mode, and getting to whatever we can, and having to make decisions about what order to do things. But it's all important. So, but I just want to say, please don't be upset if I don't get immediately back to you. Okay, let's take a look at markets. Coronavirus's impact on major world economies. This is not exactly right, the way this slide is phrased. I didn't make the slide, but I'm showing it to you. This is not the economies. In other words, not the GDPs. This is the stock markets. And I'll just do my drawing tool here. And this is China, down 10%. And this is, let's see, light down 31% is India. So interestingly, since the beginning of the year, 2 emerging markets. One is China, the other is India. And then sandwiched in between, this is, let's see, this is Japan right here, next. This is United States, 20% down from the beginning of the year. Next is, let's see, next is France. And then after that is Italy. And then after that is the United Kingdom. So just to give you an idea of the range of outcomes, everybody's down. Everybody's down. But that's the way the major countries look. Now, sorry. Yeah, okay. So the U.S. economy, and way down here is the energy business, 3%. And so it's really had a you see, it doesn't even group with the rest of these. It stands alone, down 53% on this scale. This dark green is consumer staples. No surprise. And then after that, technology. As we all learn to use all this remote technology's help. Next is, let's see, what is this purple? Light purple. Oh, no surprise. Healthcare, only down 15% only, right? Utilities, right? We got to keep the lights on. Down only 18% only. Next, communications, right? We still got to pay the internet. And so not much surprise here. Consumer discretionary is right here, right? Not a lot of automobile selling. Materials, and then industrials, and then financials have been hit pretty hard, right? Look at that, down 35% on the financials. So that's the way the sector performance. And of course, this is why we diversify to hold a portfolio that's got some things that are doing okay and some things that are not. And then here's the details on what's going on with oil, right? Look at that, down 63%. That's the price of the commodity itself has just totally plummeted from, now this is from last year. It's back to April of last year. And you see it just fell off a cliff. And as most of you know, there have been discussions between Saudi Arabia and Russia over the last few days. Vladimir Putin, I think, this afternoon said, well, if the U.S. agrees to shut its production down, then we'll agree to shut our production down. And of course, the whole position of U.S. producers since the shale boom has been that the U.S. is the swing producer. When prices are such, the U.S. will automatically, prices are higher, the U.S. will automatically jump in and start to produce. So what Putin is suggesting is that the U.S. will controls on its oil business. We'll see how that goes. And then this is what it translates to year to date. This is the market year to date. I've shown this before. And see, I got to change my color of my drawing tool here. Okay, there we go. And of course, Amazon, right, up 3% on the year. Microsoft not too bad. Look at that, Google down 18%. Facebook down even more. Apple. Look at the banks. Down 43%. JP Morgan. Very few up. Netflix up 11%. Gilead and Regeneron here, but you see it's just all red everywhere that you look for the year. And as I've noted before, I got to move this drawing tool here. Hang on. Okay. As I've noted before, look, here's the oil business. ExxonMobil and there's Chevron, and then these are the independents and the here's Schlumberger, right? So the equipment guys, but you see what a small portion of the entire market the energy business is, right? Imagine if we were back 30 years or 50 years and the oil business fell apart. But now look, the technology business is huge. Even the businesses that are considered to be consumer goods businesses are technology businesses. Look at that, Apple is in the consumer goods. It could just as easily have been put into that sector, and make the technology sector even better. Amazon, right? Is it a technology? Well, it's technology, but it's consumer services also, right? Look at that. Amazing. Here's Verizon, communication services. Boeing has been absolutely destroyed. Anyway, so that's what we look like on the year. Okay. It says my internet connection is unstable. Here's the S&P 500 daily change, and this dates back to last year. So I mean, look at that. So it's like a heart EKG, and then just look at how the chart just goes haywire. Look at that. Look at this volatility. Look at the changes. This is percent daily change, right? So we're usually looking at a percent daily change of around 1%, right, up or down. And look, we've had changes in the 5%, lots of 5%, plus or minus 5%, plus or minus 10% in this box that we've been in recently. So certainly the volatility that we've seen is not normal. What's causing such anxiety among investors, understandably. And here's another way that you can see it. All right, this is the VIX. VIX is the volatility index. And here we are. Here we are. And, the closest thing would have been back in 2008, September of 2008. Closest thing. They're pretty much even. So we're getting the same sort of panic as we had back then. I don't know, I shouldn't use that word. Same sort of volatility. Now, this is the same thing. This is volatility again, right? Same VIX index, but it's over 5 years rather than going back farther. And we have huge volatility right now, but look, it's fallen off in the last week or so, right? So I can't tell you where it's going to head next, right? But look how sharp the rise was, right? I mean, look how sharp this rise, and then we've had a fall off in volatility, and I think everybody. But I just wanted to show this to you so that it verifies. If your perception is things are a little less, volatility has fallen, then you're correct. Yes, that has happened. We're still not back. Today we were down again, 2%. But 2% is a big difference than 10%. This is the S&P 500 going back, way back. This goes back to 1980. And the reason I'm showing this to you is well, first of all, you can see that in previous downturns, this is the tech bust. Look, that was. And even in 2008, yeah, it's very, but it doesn't look anything. I mean, this looks like a global pandemic hit or something like that, which is exactly what's happened. I mean, that's what a global pandemic looks like. It's not a slow rolling tech bust like this, or even a fairly rolling financial crisis. It's just blammo, and you can see that here. But look, the trend of stocks over this time is still largely up. So I want everybody to see this drop, which steep and rapid as it is. I want you to see it in context with the entire index. We started is the basis here, and we're still all these years later north of 2,000, 2,500 or so is where we're at right now on the S&P 500. So that's the long view, even after the drop. Hopefully that gives you some comfort. Very interesting slide. This is from January of 2009, which would have been around the time that Barack Obama was inaugurated as president. And you may remember September of 2008 was the beginning of the crisis. So just after that, and then this is through, so basically this is 2009, right? That's what we're looking at. And you may remember that stocks bottomed March of 2009. I can't remember the date. I think it was the 13th of March in 2009. So this is the bottom of the market. Now, we were not in that point, and the number that we're showing here, this was the height of unemployment right here. Okay, so unemployment peaked there. I don't know, it was somewhere around 10% or something on the official records. And so unemployment continued to rise all during this period. All right, but look, so did stocks. How could that be? How could it be that the unemployment all along this time, from March of 2009 till unemployment peaked in October, and yet stocks went up? And the answer is that the markets had already baked in the rise in unemployment. The markets were already aware of that. And what is this rise in the market from the bottom? The rise in the market from the bottom, it's not this number. It was a 50% rise in the market. 50%. That's how much the stock market rose from this bottom to this top, to this, not even to the top, but just to the point where unemployment peaked. A 50% rise in stocks. So that's why we don't know where bottoms are. But generally what we see is that your recovery in stocks happens very rapidly. And if you miss this piece of it, you've missed in many ways the steepest rise. You can see that. You can see how steep this part of the rise is right here, this area right here. So that's why it's very, very difficult to call bottoms. And if you miss it, you may miss a stocks. Anyway, this is the record. I want everybody to see the last time we had a major financial crisis, and we have one now. in addition to a health crisis, this is what happened when we hit bottom. And how many of us are going to be able to say, oh, yep, that's it. This Tuesday, that's it. It's bottom. All statistical studies say none of us, no one has ever been able to do it. You know, they've studied this. Does anyone have the ability to predict where? Nope. People may tell you they can, but they can't. All right. Next. So this slide, and I've shown this in various different incarnations. This goes back to 2009, January 2009. So that was included in the chart that I just showed you, all the way to the end of 2018. We could go to 19, but anyway, the 18. If you were invested during the period and stayed invested, your $1,000 original investment, you had amount. If you missed the 10 best days in the market, your return falls to this, 1,722. If you missed the 20 best day, then here's what your return was under what your, no, I'm sorry, not under, almost under your original 10,000. 30 days, now you're under the original invest. So the point here is that, yeah, we need to be invested if we're going to get our full return. And one of the things that's very important to understand, especially lately, remember the slide with all the volatility, is that we're often seeing the best days in the market the day after one of the worst days in the market. That's why, and what we often see during these volatile periods go together. It's hard to separate them out. In fact, a few weeks ago, the market was up for its strongest day, I think, since the 1930s, up 10% or something like that. So this slide is designed to show you that if you miss those best days, you don't get your return. Okay, I want to talk a little bit about rebalancing. I've had questions about rebalancing, and so I want to inside the practice here, so you get a feel for that. And by the way, if you have any questions about markets or anything else, go ahead and put them in, and we'll get to them. So what does rebalancing look like? Well, I get a screen. This is the technology that we have, and it'll tell me. Is something out of balance, and I'm looking at this column here. So, you know, balance, and we've got some out of balances right now because the markets have been moving. You know, and how much dollar-wise is something out of balance? You know, and is there an opportunity tax losses, and is there cash to invest? So this is a dashboard that gives me a look at the whole practice. You know, when was the last time that something got rebalanced? So very, very helpful. And this is technology that I have every Fidelity or any other sources to this software technology. And then I can use this to make some decisions about, is there something I want to do? I may want to rebalance, I may not, but it gives me some information about where. If I do, then this is a particular client that I'm looking at. Obviously, the name I've blotted out, but it'll let me go ahead and see if I want to rebalance. Do I need to address any tax loss harvesting? It'll give me all sorts of readouts, looking at tax rates. Are there capital loss carry forwards? All sorts of things that help me look at the entire portfolio and whether there are opportunities that I want to take account of. And then if I say, all right, I want to go ahead and proceed, then it'll make a whole trading plan, right? It'll tell me, oh, we're going to sell 133,800, some of this, etc. And I can look at this and see, do I like it? Do I not like it? Are there adjustments I want to make? And if I do, then I can take this, and then this uploads to Fidelity. And so what I like, and I want everyone to feel comfortable with, is that we don't make trading mistakes, right? I get everything set here, and then rather than having to key in trades, the trades are already built in the software. get uploaded to the custodians, in this case, Fidelity, and then Fidelity goes on to make the trades from there. So I thought people, sort of how the trading operation works and how the rebalancing process works. It's one thing to say the word rebalancing, it's another thing for you to see, what's the technology that works. Also, on financial planning, we've done some really good work lately, and one of the things we did last year, in the middle of last year, was to change our financial planning software, and it's really one of the best decisions I've made, because, and I did make it a lot in helping me decide. We liked the software with it. Why am I showing this to you now? Because this really is the thing that every one of us should be looking at when markets are volatile, which is, can I make my goals? Can I do the things I want to do? Am I gonna be okay, right? So this is a client that we did some work with the other day who was very nervous about the markets. This is what we do when we run a financial plan, put all the information into the plan and stress test it. And we ran it under really good markets, right? And so a good market is this line right here, that this particular client can live in these. And if we're going to run out of money, then we would see the lines hit down into the dirt there. So this is really positive markets all along the way, and investment returns all along the way. And here's worst case. So what this shows is that under all scenarios, the client makes it through in flying colors. So if anybody, and we're always rerunning this for clients, but if anybody on the call says, I want to do that, I want to rerun my numbers, this is really the important numbers to be looking at right now, more than the market itself, right? Because this is your personal situation. So we will be happy to do it, and we can do this remotely now that everybody's locked down in quarantine. We have no problem working this remotely, and we're happy to do it, okay? And I'm going to show some more. I'm going to show a couple more slides here from what we do with this. We can stress test, all right? So somebody says, well, fine, but what happens if the stock market falls 50%? Well, in this particular client's case, we did that. We said, destroy the stock market, take it down. I don't know. We said 75% or 80. We may have said 100%. And in this case, the client still is in such a strong position. This particular client's in strong position. And that was our job this week, was to show her, you're really, really in strong position. She was very, very worried and very anxious about the state of markets. And so we put her mind at ease by showing, look, even under really, really bad market crash conditions, you can do what you need to do. You can pay your bills, and you can, pay for your son's wedding, and so on and so forth. And it's not just market crashes that we can test. You could say, well, I think taxes are going to go up. Okay, fine. I think Social Security is going to be shut down. I think I'm going to live till 150, and my money's going to have to last that long. I think we're going to see really, really high inflation is going to go through the roof. Okay, fine. We can model all of that and then show, what is the effect on your probability of success. So just to show everybody, if you want to do this work, we are happy to do this work during this time. And then we can also show you where is your income going to come from? What is that going to look like? So in this case, there's a Social Security component. You can see that in this particular plan, right? All this purple stuff. And then there's going to be some other income. In the case of this client, right, they've got these other income, could be royalties or pensions. And then the rest of it's going to come from savings, all this up in orange. And there's no shortage. If there were shortages, you would see, a red bar up here. And so this particular plan shows no shortages. So we can show that to you as well. And then last of these screens, we can give you a detailed understanding of what your cash flows look like. So in the year 2021, this client's going to be age 67. Here's income inflows, total that. We look at expenses, which is an outflow. These are all the outflows. What are the goals? what are taxes going to look like, total outflows. In this case, there are going to be some shortfalls, but it's okay. Client has enough money to meet those shortfalls. So we can project your cash flows all the way to the end of your life, and give you a clear idea as to whether your spending and your budgets are within reason, given your resources, both now and in the future. So that's it today. That's a pretty short presentation I wanted to put together. I've gone on long in the past few weeks. I didn't want to do that this time. 6:42, not too bad. So I'll go ahead and stop now to take any questions that people have, and turn it back to Catherine for that.
Yeah, we had one question that came in during the presentation. Also, if you have a question, please feel free to type it into the Q&A. And also, before I read the first question out, I'm going to be sharing the link for the evaluation survey. If you would please answer that before you jump off, we'd appreciate it. And I will share that link right after I read this first question. So the first question is, what segment of the investment community, for example, pension funds and the like, are responsible for the large swings in the S&P?
I haven't read, have I read anything about that? I don't think I've read something specifically on it. I think I may have heard some stuff. So let me just say I'm going to do some speculating here. I do not think stock market volatility has been coming from average rank and file investors per se. I don't think it's been coming from pension funds. I do think that probably there has been just a general rush for liquidity, and that may have resulted in people selling mutual funds, some forced sales out of mutual funds. That's happened in the bond markets also. And I think probably some of it's been coming from program traders as well. But I doubt that if you're asking specifically about pension funds, I doubt pension funds have been sellers of stocks. But I don't exactly know the question. But I want to remind everybody that whoever has been selling, someone else has been buying. So it's always hard for me to say, well, who's doing the selling? Someone's doing the buying, and so it could be some of each. There could be pension funds that are doing some selling and pension funds that are doing some buying, and individuals who are doing some selling and individuals doing some buying. The fact that prices are down just means that not that there aren't buyers, but that buyers and sellers are coming to agreement. Don't worry, the cough is just I got back from Colorado, and so I'm sort of adjusting the humidity and stuff. So the buyers and the sellers of the world are simply agreeing that we have a new set of facts. Specifically, we're looking at lower earnings for companies, and therefore the price at which stocks trade is lower than it was. It's a good question. I don't really know who has been selling specifically. If some segment has been a bigger seller than buyers, or bigger seller than others. But again, I think the main thing is that we've got buyers also. If there were no buyers and everyone wanted to sell, what would be the price of assets? Zero, right? Nope, nobody's interested at any price. So clearly we have buyers. Even today, market's down 2%, there were buyers today. Next question, Catherine.
Yep, sure. We've got three questions in the queue, so thanks for those, and keep them coming if you have anything else. Next question is, what is Warren Buffett doing now?
The only thing that I believe Buffett has publicly been reported to have done, and I think from one of Berkshire's filings, is that they issued bonds in Europe and in Japan. They issued corporate bonds. So Berkshire went out and borrowed, I think it was $1 billion, which is not much for Berkshire. If you think about it, Berkshire's got like $130 billion in cash reserves, so $1 billion. But that's not unlike Buffett to look for times to opportunistically add some cash. I think that's the only reported thing so far. So Berkshire, and not just Berkshire. At the beginning of this, during this crisis, the heat of this crisis a few weeks ago, the financial part of it, companies could not issue bonds. They could not issue bonds. And then just about a week ago, the window opened up, and there was like $100 billion in corporate bonds that were issued at these really low interest rates. Corporations moving to take advantage of really, really low corporate bond rates for investment grade bonds. And Berkshire was one of those. But we won't know. We won't know until Berkshire makes its filings, which should come pretty soon, as to whether they were active in the market. But I'm sure they have. I'm sure they were. Buffett never fails to take advantage of big drops in the market. Okay, next question.
Next, okay, with the rebound, relatively speaking, in the stock market, are you pleased with where things are now? Said I wasn't on the webinar. Oh, this is someone who joined in halfway through, says wasn't on the webinar in the first half hour. Do you think the shock factor of COVID-19 has worn off to a major degree, re the impact of the stock market? Thanks.
That's a really good question. The market is taking in all information, every minute. I would not be surprised if we plumbed the lows again. We could even exceed the lows. And what would do that is the market got new information that let's say that the market is expecting, and I have reason to believe that the market is expecting that corporate earnings this year are going to be de minimis. What does that mean? That means that if the Standard & Poor 500 was earning 150, which is probably about where it was, $150 a share of the S&P 500, that would go to zero. Right? That would mean the biggest businesses in the United States, and you could spread this over the rest of the world too and say it about their big indexes, but was going to be zero. No earnings. There are some outfits that are speculating a loss, that when it's all put together, not only is corporate America going to make zero, they're actually going to lose money. So what if the numbers come out and they don't just lose money or a little bit of money, they lose a lot of money? So we're in such uncharted territory about the effect on businesses that it just isn't impossible that the market gets new news that none of us know, and it's just really, really bad. Or we could, there's all kind of news we could get. We could get news that it wasn't as bad, and that all these businesses that are finding a way to make money, whether it's restaurants that are doing takeout or technology businesses that are actually doing more business hand over fist, whatever. Consumer goods companies and grocery outfits, that we end up not losing as much money, or the earnings don't do as poorly as they were supposed to, or we get some news that vaccines are starting to emerge and get tested. I mean, anything could cause the market to surprise to the upside. We're in a global pandemic, and so That's why you've probably seen in your account, I've put some cash into your accounts. And but I'm trying not to eviscerate the stock holdings in your portfolio, because of the slide that I showed farther back, echoing 2008, where the bottom happened in March of the bottom happened in March of 2009. That was what, 5-6 months after that crisis began, September to March, and then it was a 50% gain from there. So how am I feeling? I feel fine. I feel good. I feel like, we are practicing our discipline with investments, and as a professional advisor and professional investor, that's all we have during crisis times, is our discipline. And it's the same discipline that doctors bring to their profession right now. They're going to lose people, but they're going to still practice their profession. And they're going to be under stress. We see that, and it's terrible. But they're going to practice their discipline, and our discipline as financial advisors is to understand past events, past market stresses, and they're not going to be the same every time, and this one is certainly not. But there's going to be some rhyming that goes with them, and that's my goal, is to always keep those things in mind and practice the discipline. So I feel fine. I feel good. Why do I feel good? Because I feel like our team has an ability to work for you, and to work with you both as a practice and on an individual basis to satisfy you that your portfolio, your needs, et cetera, are going to be where they need to be. We need your help. If you have questions or doubts or whatever, we want to hear from you. How you feel and what you think is an important part of the feedback. It's the science, yes, but it's an art also. And so if you're uncomfortable with something or whatever it is, I'm here to talk with you about it. But I feel good. I feel fine. I have, I've been more of a buyer in my own portfolio, but I have a long time horizon. I'm not retired or moving toward retirement right now. So that's how I feel about markets, is they're giving me more of a discount. I hope that as a long-winded answer, but it was a really good question. Okay, next question.
Sure, this is the last one for now. It says, as the corona...
I'm sorry, Catherine, either I'm breaking up or you're...
Okay, it's kind of...
It may be me. It says my internet connection is unstable. Okay, read it again. I think I'm cleared up now. I think the packets have cleared.
Sure. Okay. It says, last question says, as the corona numbers get worse and the news becomes more dire, provide a worst case projection of the S&P bottom and when. The medical community is projecting much longer self-quarantine than the administration. Earnings will be lower than they are projected now, right? Oh, sorry.
Okay. So here, let me go to my spreadsheet. Catherine, is this showing up on the?
Yes. Yes.
All right. So I went through this on one webinar and I got complaints I was getting too technical, but this question calls for it. All right. So to take everybody through it again, this is the 10-year Treasury as it ended today, 62 basis points. This is the equity risk premium. This is the premium above the 10-year Treasury bond that you can expect, if you will, above the 10-year Treasury. And I put it at the high side, which means a higher discount rate, a higher hurdle rate, which penalizes stocks more. This is a pretty high discount rate, 5.5%. Could be as low as 3.5%. I should put that here. Usually 3.5% to 5.5%. Okay. So that gives a little annotation. The discount rate is the, the discount rate's exactly counting future cash flows at. And that's the sum of row 4 and row 5, right? So that's just this plus this. Now the growth rate's the growth rate of earnings. And that's recently, about 7%. So I've put it at 5%. And that's sort of a steady state run rate for earnings on the S&P 500 in normal times. Robert Shiller would argue with that and say, well, if we go back to the 1850s, you know, the average has been 3.5%, but it's been much more rapid in modern times. Well, here's the current price of the S&P 500, 2481. So to remind everybody, what I did is I went down and said, here in 2020, $1. Let's say the S&P 500 makes $1. Almost nothing. And then let's say in 2021, we get a recovery. I said it recovers back to 80. You know, pretty rapid rebound once the all clear is given, but still half the level that it was before the virus. 150, you know, let's say it was about 150. I think it was a little higher, maybe 155 was the earnings on the S&P 500. 155 when virus, you know, broke. All right. So 80 is still half of, on 2021, half of where it was before the virus. Then I say, let's have a U-shaped recovery, right? Everybody's saying we're not going to get a V-shaped recovery. Let's get a U-shaped recovery. Fine. You know, we go to 100 on the earnings the year after, and 120, we're still not back to where we were before the virus. 140 in 2024, we're still not back. And then 2025, we're still not back. Then I say, fine, let's slow the growth rate to whatever this 5% growth rate is. I hope this isn't too technical. You see, I'm just building a spreadsheet and putting in some assumptions for when do the earnings come back and how fast. And then let's say we grow it at the 5%. They're on out, which is still below the 7% it was. Let's just say that somehow the virus has impaired the ability of corporations to grow, or the government takes actions that move us more towards socialism and that hurts the growth rate of corporate profits. So it's a pretty conservative scenario that I've put in. And then what's the present value? All this has to be discounted, right? Because future earnings today are not worth, they're going to be worth less today than they would be worth then, because we have to discount them back to the present because of the effect of inflation. In this case, the effect of the discount rate, the 6%. So all of this, all these earnings right here in column B are getting discounted back to the present using that discount rate. In other words, in 2026, for example, this 154 today, in today's dollars, is only worth $108. And that's what's important to us, not the 154 later. Yeah, it's important that it be 154, but what's important today is what's it worth? What are we willing to pay today? This is like wimpy, right? Wasn't there something, what did he say in Popeye? I'll gladly pay you, I forgot, what's the hamburger thing he says? Somebody type it into your thing. I'll pay you today for a hamburger tomorrow. It's kind of like that. You know, what will you pay today for $154 in the year 2026? If it's a 6% discount rate, you'll pay $108 to get that 154 later. And then this shows you what's the multiple of earnings. So when I add this column up, right, that's where we get these numbers. Well, under that scenario, that would price the S&P 500 at $2,039. So there's some downside from 2481. But if you're willing to hold your investment for 20 years, now we're 15% undervalued. 2923 would be the value on a 20-year time horizon. On a 30-year time horizon, pretty undervalued under these conditions, right? I'm not saying these are the conditions that are going to happen. I'm saying this is pretty pessimistic. Well, what these charts out to the right show you is what about a whole range of conditions? All right, so on a 10-year basis, what if growth is only 3.5% from here until kingdom come, and we have a really high, in other words, the most pessimistic scenario, 1910. So that's what I want everybody to see, that under kind of a really, really pessimistic scenario, 1910 is kind of the floor under most pessimistic. That's a pretty good ways down from here. That's under most pessimistic. But what if on a 20-year basis, we get 6% growth, and you say, well, the equity risk premium is too expensive. 5.5% is really extreme on an equity risk premium. Let's take somewhere in the middle. Well, now that's 36.66. So everywhere you see in green, we've got a pretty good margin of safety under these different assumptions. So on a 30-year basis, the S&P 500 looks good here. If you have a really long-term time horizon, 20-year time horizon, it's all green. It's only in this shorter time horizon that we start to see, well, there could be some downside if you are a 10-year investor. So this is more answer than you wanted from the question, but if it's not clear, get back. Whoever asked the question, get back to me, and I'll see if I can make it simpler. But this is how I'm looking at it. And by the way, I don't know any other advisor who has this. I really don't. I don't even think, honestly, that the big guys have this. I'm not bragging. I'm trying to make you feel good as a client. I don't think that Goldman, has built this kind of thing, or any of those guys. So I fill out the numbers for the S&P every day, and I'm really trying to keep a good handle on it. But I'm just here to tell you that, yeah, sort of under these scenarios, call it 2,000 on the S&P. We could see it. It's possible. If that changes anything in your thinking or your time horizon, let me know. Any other questions, Catherine?
No, that is the last question.
Okay, everybody, have a good weekend, and we will continue to watch the news in the markets. And I hope everyone will be well and be safe. And I hope that the three of you who raised your hand, and I know people who are affected, I hope that they will heal as soon as possible. And I hope that everybody else who didn't raise their hand will not raise their hand on our next webinar. And we hope that the people of the world and all the beings of the world will be well, and we can all recover from this really deep trauma. My wife is a therapist, and I told her, I said, you guys are going to have to be ready to do. It's probably the therapists who are going to be working on this longer than any of us. The financial advisors are first. We get the first wave of it, and of course the doctors are going to be at it for months and months. But I do think the therapists are going to be trying to help the world heal for years and years. So we will be very thankful for them and all their great skills. Okay, everybody. Thank you for giving us your time this evening. Hope it was good.